Good afternoon, or possibly good morning, where you're coming to us from today and listening to our webinar on protecting your retirement from a recession. We have a great guest speaker on today who's going to share her thoughts on the best ways to protect not only your retirement, but really any funds that you have invested from an overall recession. I'm sure many of the people on the call have experienced at least one recession, if not more, unfortunately. Um, so it's really important that we think about the different things that Jan's going to share with us today and position ourselves appropriately. My name is Scott Maurer. I'm the Director of Business Development for Advanta IRA. I've been with the company over 15 years. I've done everything from helping people with their individual investments to obviously teaching classes and educating people about what self-directed IRAs are and the ability to invest in other types of assets. I'm also a licensed attorney, although I don't do any legal work for our Advanta clients. Just a quick disclaimer, Advanta IRA and its employees do not provide any investment advice or endorse any particular product, so it's always incumbent upon you to do your due diligence on investments and making sure that you're comfortable with that investment from that standpoint. And the presentations that we do are from an educational perspective. If you need legal or tax advice, we can certainly refer you to CPAs or attorneys who may be able to give you that type of advice as you go forward with your investing. Just a little bit about Advanta IRA. We've been in the industry for over almost 20 years now, and the only thing we do is self-directed IRA account administration. We have over $1.8 billion in assets under management, and we set ourselves apart with our concierge level customer service, where every new account holder gets assigned to one particular individual in our office to help them with anything they need regarding their particular account. Now, as you listen to the webinar today, if you're listening live, there's a question box on your GoToWebinar dashboard where you could type any question that you have either for myself or for our guest host as you go along. We'll make sure to get those questions answered during the context of today's presentation. If you are listening to the recorded version of this webinar, just jot your questions down and you can either reach out to myself or our guest host when you get a chance. We'll have all of our contact information available for that. Just very quickly, for those people who are unfamiliar with self-directed IRAs, a self-directed IRA is an account that gives owners the ability to invest in a lot of different types of assets and basically getting complete control over what investment classes that you're looking to invest in. There are certain brokerage firms and other types of companies that offer a quote self-directed IRA where you're still picking from mutual funds, stocks, bonds, products that that particular custodian is only willing to sell or hold. But a truly self-directed IRA allows you to invest in a lot of different types of assets in what we call the term alternative assets, because for the most part, they are not publicly traded. That's going to be what we talk about a lot more today as well. Now, the motivations, why do people choose to self-direct? For some individuals, using their IRA account to invest in real estate or self-storage or multifamily real estate, all the different things that you can do with a self-directed IRA, their motivation is that the IRA, maybe their old 401k, is providing them with a new source of capital. It's new money that they can use to take advantage of an opportunity that they don't want to miss out on. So perhaps they already invest in real estate on an individual basis, and the IRA just provides them cash to buy their next deal. A lot of clients, though, and this is going to tie into what we are going to talk about today specifically, is the stock market fatigue and the people being unsure, unsettled at least about what is going on in the publicly traded markets and wanting to have at least a portion of their funds allocated into assets that are not directly tied to that stock market, really to better diversify and allow them to sleep a little bit easier at night as well and get that money out of the account. And for some people, there are the benefits, or tax benefits. The fact that when you invest inside an IRA account, the returns, the gains, come back to your account either tax deferred or tax free. So if you're in a higher tax bracket right now, investing through your IRA will limit how much tax you would actually pay on that income. And now as we talk about real estate assets that you can hold in your IRA, that can really be anything from rental properties to commercial real estate, rehabs, multifamily, self-storage facilities, private REITs, raw land, really anything real estate that you can invest in. It's just a matter, the only restriction is you can't use that real estate on a personal note. So you can't be using your IRA to buy your vacation home, your primary residence. It does have to be for investment purposes only, but in that realm, it doesn't matter what form of real estate that it takes, your IRA could certainly purchase it as an investment property. We also see a number of paper assets, the mortgage loans, tax liens, tax deeds that are related to real estate and tied or secured by real estate, but the asset itself is in the form of a piece of paper. Again, whether it's a lien or a loan against the particular property as well. And we kind of have a catch-all category of other alternatives: LLCs, farm animals, private partnerships, movie projects, precious metals, which has certainly seen a resurgence lately. Cryptocurrency is not on this list, but something we've had people inquiring about a lot as well. So really the key thing that all of these assets in these various diverse industries have in common is that since they're not publicly traded, you would need a self-directed IRA to hold and to invest in any of these assets that we've listed here today. And that's what we do at Advanta IRA. We facilitate you investing or purchasing these assets inside of the IRA to keep the IRA tax deferred and going forward. We also provide a lot more education. Today's event is just simply one of the many events that we hold on a yearly basis. We typically do 1 or 2 webinars a week with different topics, featuring different guests in a number of different areas as well. And we have an online networking event that I'll talk about hopefully here in just a moment, that you can join to meet people all over the country and try to look and see what you're looking to buy or what something you're looking to sell, and find like-minded investors. So all of the webinars that we do, whether it's the one you're watching today, or whether it's one you've missed in the past, or something comes up in the future that you can't make, all of the webinars that we do get recorded and placed on our Advanta YouTube page. So you can go there at any point and watch the list of all the different events we've had in the past. I mentioned our online networking forum, as we call it, Pitch, Promote, and Prosper. It is an event that takes place every other Friday, just about, from 12 to 1:30 Eastern time. It is a chance for individuals to simply come on. We provide the platform for people to introduce themselves, tell what they're looking to buy, what they're looking to sell. In this, whether it's related to your IRA or not, it doesn't matter. But it's a great networking opportunity. We've had a lot of people joining. We're usually getting at least 50 to 60 people on every other Friday to talk about, again, what they're looking to invest in and to bounce ideas on off each other. So you can register. There's a link at the bottom of the page, or just go to our website at advantaira.com, click on the events tab, and you'll find out when that next upcoming Pitch, Promote, and Prosper event is. But again, that was just a brief introduction to self-directed IRAs. At this time, I do want to introduce and bring on our presenter today. Her name is Yanyan, and she is a market risk manager on Wall Street, and she uses her data mining skills to identify long-term trends in real estate investing. So we're very happy today to have Yan on to talk again about what she does from a self-directed, or not just self-directed IRAs, but retirement accounts in general. So again, now if you're listening live, if you have any questions for either myself or Yan as we go along, please type those in the question box on your screen. We'll make sure we get those answered as we go along. But Yan, how are you doing today?
I'm doing great.
Good. I don't know if I can, let me make sure I can see your screen here. Yep, there it is, it's up. So I'm going to turn it over to you. And again, if anyone has any questions as we go along, please type them in, and I might interject with my own questions here as well. So Yan, the floor is yours.
Okay. Thank you so much. Thank you, Scott and Advanta, for giving us the opportunity to present how to protect your portfolio from a recession. We have a lot to cover today, so let's get started. First, this is our legal housekeeping. We are not investment advisors, so please always do your own due diligence before investing. This webinar is for education purpose only. We will cover 4 topics today. First, we will introduce our team, our experience, and how we can add value to passive investors. Second, we will talk about a framework, 3 steps to protect your portfolio. Then we will use a case study to show how I use this framework in real life. If you want to find out more, you can find our contact information at the end. We will also answer your questions at the end. So let's get started. Sharp Investor Group is a private investor group. Our focus is to invest together with our passive investors to achieve asymmetrical returns with downside protection. On the left-hand side, you can see my partner, Henry Yun from Seattle. He has engineering background and work as a project manager for a Fortune 500 company. He has 9 years experience in real estate investing and renovated over 50 projects and built 5 single-family homes. He's also a super host on Airbnb. On the right-hand side, that's me. My name is Yanyan. I'm a market risk manager at Wall Street. My risk management and portfolio management experience, as well as data mining skills, give me a unique edge in terms of real estate investing. Like many of you, I want financial freedom, but being an individual passive investor poses a lot of challenge. I believe the co-investing model is the way to solve these problems. We will discuss the details in a minute. I'm very passionate about sharing what I learned along the journey. At the bottom, you will see some sample webinars I did last year. Each topic addressed specific questions in real life. All this can be found on our website, www.shopinvestorgroup.com/webinars. Welcome to subscribe to our free weekly newsletters to get notified about a new deal or a new educational webinar. Lastly, in my free time, I enjoy running. My marathon record is 3 hours and 35 minutes. Marathon training taught me planning, execution, risk management, and patience. As a passive investor, you might find the following hurdles very familiar. You may be too scared to invest because you think that you know nothing about investing. You may have no time to do the research, or you have time, but you have no deal flow. Or you can't tell the good deals from the bad deals. Or you may have 2 deals to analyze. When you finally decided to pull the trigger, you found out the deal is already oversubscribed. Lastly, because you're only familiar with 1 or 2 asset class, you ended up with an over-concentrated portfolio. Those are all the hurdles as individual passive investors. At Shop Investor Group, we are very keen to provide a one-stop solution to solve all these problems. We provide free educational content through weekly newsletter, as well as an hour-long educational webinar like this one on specific topics. We research economy, market cycle, asset class, and also regions. We only source deals from the sponsors that pass our strict vetting process. We underwrite deals independently and do it in a systematic way. We co-invest with like-minded passive investors and leverage that to negotiate a better term with the sponsor. Imagine this is a Groupon model for real estate investing. Lastly, we want to build a diversified portfolio across different strategies, different asset class, as well as different sponsors. We understand your struggles and we will be there for you. Let's jump to the second part. Portfolio protection in 3 steps. A lot of people think investing starts with accurate predictions about the future. How will the economy perform in the next 2 years or the next 5 years? Will the Fed raise interest rate? Is there a housing bubble ahead of us? But I want to tell you that prediction is not our business, as we can do a better job. Here are some examples. These are the worst economic predictions ever made by highly intelligent people. First, let's start with Fisher. He's one of the America's greatest ever economists. In October 2029, he made a prediction. Equities had reached a permanently high plateau. The reality is that less than 2 weeks later, stock plunged and didn't reach the highs for 25 years. What about the next one? Abby, the Goldman Sachs chief investment strategist, make a prediction in December 2007, S&P 500 will hit 1,675 by the end of 2008, a climb of 14%. In reality, it ended up below 900. Okay, the last example was from David, former National Association of Realtors chief economist. He wrote a book in early 2006 called Why the Real Estate Boom Will Not Bust and How You Can Profit from It. As you can imagine, it didn't age well. So is this the bad news or good news? The bad news is that we can't expect us to do a better job than those economists. The good news is that we don't have to. Here's why. Okay, so I will tell you a three-step framework to protect your portfolio. Step 1, scenario analysis. Step 2, asset classification. You want to classify different assets into two buckets. One is called risk-on assets. The other one is called recession-resistant assets. Step 3, construct a diversified portfolio based on the first two steps. I will explain each step. Step 1 is scenario analysis. The difference between prediction and scenario analysis is that the former has only one outcome, and you only get 50% of being right. With so many moving pieces, it's definitely not easy to predict one outcome with certainty. On the contrary, scenario analysis assumes multiple outcomes with different probabilities. You've already seen this in weather forecast. Let's say that tomorrow there's a 20% chance of sun and 30% chance of cloudy and then 50% of rain. In portfolio management, you can do the same thing. You may come up with a different scenario, base case, best case, worst case, and assign them with different probabilities. So that's first step, scenario analysis instead of one prediction. The second one is asset classification. You know that tomorrow there's 20% chance of sun, 50% chance of rain. So your plan is to have sunscreen as well as umbrella with you. In portfolio management, our goal is to invest in different asset class so that our portfolio will be perform well regardless which scenario it plays out. To do that, you need to understand the characteristics of different asset class and put them into different buckets. So here on the left-hand side, you can see what we call risk-on asset. So it has positive correlation with the economy. So some of the examples are stocks, oil, or the real estate targeted for appreciation. In the middle, we have bond, gold, and yen, the Japanese currency, which has negative correlation with the economy. And to the right, we have a third type of asset class, which has no correlation or very low correlation with economies, such as ATM. So the middle and the right-hand side of the asset class, we can call it recession-resistant asset class.
Hey, Jan, I have a quick question for you. On that last screen, are there any other assets? I know you have the ATM listed as the no real correlation. What other assets are kind of in that place where there is no correlation with kind of how the market's doing or how the economy is doing as a whole?
Right. So if you invest in stocks, you know that they classify the stocks into 11 or 12 sectors. One is called consumer cyclical. The other one is actually regardless of what, you always need to buy those stuff. Those sectors actually had no correlation with economy at all. Right. So like food or like baby goods, things like that. It has very low correlation with economy.
Okay. All right. Thanks again. Anyone who's listening live, if you have any questions, please get them typed into the question box. But Jan, go ahead.
Okay. Thank you for the questions. Now let's move on to step 3, diversification. So remember, the first step is that we assign different probability to different scenarios. The second step is that we put different asset class into 3 different buckets, one in risk-on asset class, the other 2 in recession-resistant asset class. Now, let's move on to step 3. we need to assign different weights to different asset class to construct a diversified portfolio. Once you construct a portfolio, how do you know whether it's a healthy portfolio or not? We need different measures. The first concept is risk. In finance, how do we measure risk? It's the predictability of the outcomes. So the wider the outcomes spread it, we call it more risky, because you cannot predict how your portfolio will perform in the future. Mathematically, it's calculated as standard deviation of the returns. The second concept is called Sharpe ratio. It basically measures how much return you get for taking additional risk. Mathematically, you just use the return divided by the risk, which is the standard deviation of the returns. So that's how you measure whether you get compensated by taking the risk. The third concept is diversification. So based on your assessment of different scenario and based on your understanding of different asset class behave under different markets, now you want to assign different weights to different type of assets based on the previous two steps. Okay, so let's zoom in a little bit on risk adjusted return. So this is basically the gist of modern portfolio management theory. As you can see my mouse, here is the upward looping slope. It basically tells you the combination of all the best risky assets. Okay, so what do I mean by that? Here you see these two assets. Y-axis is the expected return. And x-axis is the volatility, which is the risk. So if you look at a risky asset here versus a risky asset beneath the curve, if we draw a vertical line, we see that they have the same risk. However, this asset actually had higher return than the one below it. Similarly, if we draw a horizontal line, the expected return are exactly the same. For example, if you compare this point versus another asset here, the expected return are the same. However, the one on the left has a lower risk than the one on the right. That's why I said every risky asset on this upward sloping curve is actually the best risky asset compared to anything below this curve. Now, this point is risk-free asset, which is, for example, U.S. Treasury, the government bond. Why we said this is risk-free? Because the risk here is 0%. So if you draw a straight line, connect your risk-free investment versus any risky asset on this curve, you get a straight line. That's your diversified portfolio. So, for example, if you compare two portfolio, one is the black line, the other one is the blue line here. Which one is better? The way that we measure is called Sharpe ratio, which is the slope of the curve. If you look at it, it's actually the return divided by the risk. Of course, this one, this portfolio is better than the blue line. The reason is because it has higher Sharpe ratio, which is the risk-adjusted return. I hope this basically give you an idea how you can measure which portfolio is the best. So that's why we call ourselves Sharpe Investor Group, Sharpe with the E, not the SHARP, but the Sharpe ratio. So this is the straight line, this is the curve, and this tangent portfolio is the best portfolio, which has the highest risk-adjusted return. All right, we finished the theoretical part of it. Now let's dive into the case study, how ATM investment can improve the performance of your portfolio. So I will use my own portfolio as an example to walk you through how I think about this portfolio protection. Let's recap the three-step framework. Step one, scenario analysis. step 2, put asset class into 2 different buckets, risk on and recession resistant asset class. Step 3, diversification, basically assign different weights to different type of asset class. Okay. Okay, so let's get back to scenario analysis. So what do I know about the economy 2 years or 5 years from now? Of course, I'm not an economist. What I know from what I learned is that, okay, first, I noticed there's a disconnection between economy and the stock market. So eventually, the economy will go bad, but who knows when, right? But on the other hand, I also noticed that central bank says it will take whatever it takes to keep the interest rate low. So that's actually a good news for economy. And because these two different forces, I don't know which scenario will play out. But as a risk manager, I assign higher probability for the recession case just to be conservative. Another thing I noticed is that I can say that I have more visibility for what will happen in the next 2 years versus 5 years. Okay, so what does this mean in terms of making my own investment decisions? First, as I said, I assign higher probability to recession case. So I will assign higher weight to recession resistant asset class. Second, I said I have more visibility or more confidence in the next 2 years instead of 5 years. That means when I choose asset class, I will choose the one with a shorter investment horizon. I want to get my money back before everything turns bad. So I hope that makes sense. Now, if we look at one more thing I want to mention is that when choosing your asset class, of course, we want to invest in recession-resistant asset class. But another thing I also want to mention is that you also want to look out the competition in that space. You don't want to get into an asset class just because everyone want to get into it. Too much competition can destroy the return. So I will encourage you to research more on less known but also recession resistant asset class such as ATM. I will give you an example or the data to show why ATM is recession resistant and it's less known so that you can still enjoy high return. So that's the second step. The third step I will cover in a little bit. Let's first provide some data to prove why ATM is actually a recession resistant asset class.
Yeah, before we get into that, we did have a question come up, and maybe this is something you will end up talking more about. But just in general, someone asked, and how does your firm report its historical investment performance? If that's something you want to speak to now or speak to later, that was just a question that popped up from somebody that was learning. Obviously, as we talk about the different types of assets, recession resistant, stocks, mutual funds, et cetera, how do you all at Sharp Investor Group report kind of how your overall investment performance?
So the audience is asking for our performance or asking the performance of different asset class?
No, I think they're asking how does your firm report its, like your own firm's investment performance? And again, if that's something we can take that later, but I just wanted to throw that out there. Is that something you do on an annual basis, a quarterly basis, or I guess that's what they're looking for is how do you report your investment performance as a firm?
Right. So in finance industry, the practice is always a report returns in analyzed based. Sharp Investor Group is a newly formed entity because at the beginning I mentioned it briefly that my partner and I, we were individual real estate investor before, but then in 2020, one thing we noticed is that there's two extreme in the market. On one hand, we see there are a lot of deals coming out. A lot of them are from new sponsors, especially in multifamily space. But when we do the independent analysis, we found out that a lot of those deals that they don't pencil out. The returns looks good, but only because they throw in some crazy assumptions. So me personally, as a risk manager, I don't want to invest into those deals. On the other hand, I also noticed that some of the deals are really good, but when I decided to pull the trigger, I couldn't find out because it oversubscribed within hours. So now I'm in the middle as an individual investor because a lot of deals I don't want to invest. For some deals we want to invest, but we couldn't get in. That's why we formed this Sharp Investor Group, because together, each person, your investment is like 50,000. But if we can find 10, 20 investors, now we can go back to the sponsors and then say, hey, we have this amount of capital, and they are very happy to reserve a spot for us to get in, so that everybody, you just invest in minimum. So that's why we only have very short history, because previously we invested in real estate as individual. Only because last year when we experienced this type of dilemma, so we think that maybe someone else is experienced the same frustration as us. We cannot get into the good deal as individual investor. Then we form our company. So if you're asking the historical return for our own company, it's actually not long. So I don't think that it's fair to show you, hey, we have a very short history. I don't think that's good. But as an individual, we do have a history of investment. I hope that answers your questions.
Yeah, I think that was a good answer. We have so a couple of people just was asking. Yeah, we're talking about ATMs. Yes, we're talking about automated teller machines, and somebody was asking, of course, obviously, how does a person invest in those, and what are those asset vehicles? I know that that's your case study, so that let's let that question lead in and continue on with your slides.
Okay, perfect. This is a perfect segue to show why ATM is a recession-resistant asset class. Before we started, I want to remind everybody to open your mind, because a lot of people, including me, when we first heard about this asset class, I thought, isn't cash is dying? And I don't use cash. I probably withdraw cash maybe once a month, and all my friends, they don't use cash. So this is definitely going to die, and all those technology like a Venmo or QuickPay will kill cash, will kill ATM, right? So that was my first impression. Until I dived into it, I found out that I'm completely wrong. I realized there's a world that's unseen to me. So I would encourage you to get rid of your any of your first impression. Just open to the fact. I only present the data, not my personal personal view. Okay, let's dive into that. Okay, so remember that we talk about the first definition of recession-resistant asset class. Recession-resistant asset class must have low correlation or no correlation or negative correlation with GDP. So on the left-hand side, let's zoom in. You will see what I mean by this. Okay, so we show three lines. The first line is the orange line. The assets is on the left-hand side. It shows how much currency circulated in the economy. So we see from 1997 to 2019, it continues to grow. And after 2009, it actually accelerated the growth. So in July 2020, which is not shown here, it actually reached 2 trillion cash in the economies. That's a lot of zeros. And now let's calculate the annualized growth rate and then compare it to GDP. So the gray line is actually GDP. You see that most of the time it's hovering around -5 to +5% every year. And the blue line is the annualized growth of the cash. So we will see first between 2007 and 2009, which is the Great Recession, the economy goes down. However, the demand for cash increased. That's what we call recession resistant because it's negative correlated. Same thing happened between 2010 and 11, which is European crisis. Again, economy tanked, but the demand for cash actually increased. We also noticed that besides this 2020, the growth rate actually below 0%. Every year, the demand for cash actually increased a lot, between 0% to 5 to 10% every year. So regardless how economy behave, the demand for cash actually increased every year. Okay, let me go to this slide. To put things into perspective, let's add one more line into the same chart. So here I'm adding another line, which is the stock, SP 500. So we will see first, let's do the same thing. Let's look at the recession, 2007 and 2009. You see that economy goes bad and the stock tanked a lot. Same thing happened in 2010 and 2011. The stock tanked together with the economy. So that's why we call stock as risk-on asset, because it performed well when economy behaved well, but it performs very, very bad when economy went down. And also, if you look at the scale, it's much, much volatile compared to GDP or the cash. So some people, they only have stock in their portfolio, then they will suffer a lot if going forward the economy is going to perform bad. Okay, so now let's move on. If we zoom in a little bit to look at the growth rate by month, you will see that for the past 4 years, from 2017 to 2020, except 2020, which is the yellow line here, pretty much you can predict how much the demand for cash will increase. It's like a clock. It tracks the pattern very, very well each month. So it's very predictable. That's why we put this ATM as the asset has no correlation with GDP. However, one exception is that in 2020, starting from February, when the COVID broke out, you see that due to safety reason, people actually increased the demand for cash. That means it actually is negative correlation with the economy. You might wonder why this is the case, because based on your own experience, no one around ourselves actually use cash. So if we look into it, we will notice that in United States, there's actually 30 million households, they are unbanked or underbanked. What does that mean? That means their income is so low that they cannot afford to have a bank account, not to mention to have a credit card or benefit from Zelle or Venmo, because all of this, you have to have a bank account to begin with. So that's 30 million people that we don't know. They are a heavy user of cash because that's the only payment method that they can use. And how long will this last? Will that change very, very quick? The answer is no, because if we look at the demographic characteristics of those underbanked or unbanked population, you will notice their family income is less than 40,000 every year, and their education level is very, very low. it takes decades for the demographic characteristic to change. That's why we can make a prediction that the cash demand for this underbanked and unbankable population will stay here for decades. Another reason why we think that the demand for cash will stay here for long is because of the legislation. For federal and several states, including Massachusetts, New Jersey, Pennsylvania, New York City, and San Francisco, they passed federal and state laws to prohibit the retailers from going cashless at both federal and state level. I really like this slide because it clearly shows you the competition framework. Okay, so you will notice there's a yellow line in between. So let's start with the first part. So we can see that we already mentioned we have 30 million household. They can only use cash to pay for goods or service. And these two, this is the local road, this is the highway. You have two ways to withdraw cash. One is that you go to the branch at business hour, and then you wait in line to withdraw your cash. It's like driving slowly on the local road. Second option is that you use the independent ATM at outside of business hour at whatever time you want to, and you don't have to wait in line. It's like driving at high speed on the highway. So these two, they are competing with each other because their targeted customers are the heavy user of cash. And here is a dotted line. So here we are. So this is the heavy user of credit card or digital wallet. It's like flying from one place to another. It's very fast. But I want to point out that these two, they will not compete with each other. The fact that the airport and local road and highway coexist for a long time, we can also make the same prediction that branch, ATM, in credit card, digital wallet will coexist for the foreseeable future. Although I do want to point out that branch and ATM, they are competing with each other. Physical credit card and digital wallet, they are competing with each other. And as a matter of fact, we actually observed that ATM already won the market share from the branches due to its low cost and convenience. And so this is the blue line. Every year, the number of ATM actually increase and the branch actually decrease over the years. So quickly recap. These are all the facts. Fact number one, demand for cash has low or negative correlation with GDP. That's why it's recession resistant asset class. Fact number two, cash by necessity, meaning that those underbanked or unbankable population will last for a long time due to the stickiness of the demographic characteristics. Fact number three, for cash users, ATM won the competition with the branches. Fact number four, ATM are not competing with the credit card or Venmo. So it's kind of isolated from technology innovation. All right, I hope that I already proved to you that cash or ATM is an asset that's recession resistant. So you want to know how big is the business and how do I be part of it? So on the left-hand side, I show you a rough back of envelope calculation. From the industry perspective, on average, every ATM machine gets 6 to 8 daily transactions. If you multiply by $3 transaction fee, multiply by 365 days a year, and then also 500,000 each ATM in the United States, we are talking about a 4.1 billion a year of revenue. So it's very big business and lucrative business. Then you want to ask yourself, as an investor, how can I participate in this business? There are two types of players in the market. On the left-hand side, there's some mom and pop owners. So those owners, so first of all, their main focus is to buy ATM machine to place in new location, and they don't know how much traffic they will get. So it's highly unpredictable in terms of returns and cash flows. Second, because they are mom and pop owners, so it's very hard to scale, and they don't need the capital from outside investors like us. On the right hand side, there's different type of player that's institutional operator. So they have very good business plan. They targeted in the location with high traffic, and they have location contract with existing very famous retailers like McDonald's in New York City. That's why they can easily achieve the economy of scale and predictability of the cash flow. So they also take the capital from investors. That's why we can be part of this business. Okay, so we already proved that ATM is a recession-resistant asset class. We also talk about how we can be part of this investment. Now, I want to use a case study to show you by adding the ATM to your existing portfolio, it can significantly improve the performance of your portfolio. First, I want to mention that a lot of people think that their portfolio is just a bunch of stock. I want to remind you, actually, your portfolio is much, much broader than that. It includes your W-2 job, your company stock and options, government bond, corporate bond, stock market, and real estate. For example, I work in finance industry. When the economy is good, my income, my W-2 income, and also the company bonus and the stocks are very, very well. But when economy is bad, these two are affected. I may even lose job, right? So your portfolio is much more vulnerable to market turmoil than you think. So because I work in finance, that's why I want to add a little bit recession-resistant asset class to my portfolio. On the contrary, if you work for a very stable industry like education, I don't know, so then your income and bonus may be very, very stable. You want to add maybe stock or any other risk-on asset to your portfolio to add a little bit upside to your portfolio. So that's the first thing I want to remind you to assess how vulnerable you are to the market turmoil. Not just look at the stock, but to look at your whole portfolio holistically. The second slide I want to show you is hypothetical two portfolios. The first portfolio is a concentrated portfolio with 100% invested in S&P. The second portfolio is a diversified portfolio. It has 50% in S&P and then 50% in ATM. Okay, so the data are all the real data. We are looking at the consecutive 7 years real return from 1926 to 2020. Okay, so what do we get? These histogram on the left-hand side show you the distribution of your outcome. So on the x-axis, that's the value of your portfolio at the end of year 7 of your portfolio. Or equivalently, we can convert it into the annualized return. The y-axis showing what's the probability of each scenario plays out for the past 80, 90 years history. So the first thing we notice is that the blue bar, which is the concentrated 100% S&P portfolio, we notice that the outcomes are very widespread. It means that it has much, much higher risk because we cannot predict the return of our concentrated portfolio. It can range from losing 3% every year to making 21% every year. as a country, the diversified portfolio, which is represented as the green bar here, has narrower results. The worst case is every year you make 6% return, and then the best case is making 21% return every year. So it's much narrower spread, meaning that you have better predictability about the outcomes. The second thing you want to ask is that how well is my downside protected? For the concentrated portfolio, the S&P portfolio, you see that there's a 5% chance, this 3% plus 2%, there's 5% chance I will end up losing money every year. For the green portfolio, according to the historical data, there's not single year that we will lose money. Of course, I will not say the future is a repeat of the history, but this is what the historical data shows. So diversification can improve the downside protection. That's the second conclusion. The third conclusion is that, okay, we are also interested to know how likely my portfolio can make 6 to 9% or 6 to 15%, which is this in the middle part, which is a decent amount of return every year. So if you add those probability, you will see 51%, that's 16 plus 9 plus 26, 51%, slightly higher than 50% of making this decent return for a very concentrated portfolio. But if you add those green bars, that's 20 plus 26 plus 38%, that's 84% of chance that you can earn a decent return for your diversified portfolio. So let me quickly summarize all the conclusions. We have three conclusions. Compared to the diversified portfolio, concentrated portfolio has higher risk. As you can see, the results are widespread. Second, it also has worse downside compared to the diversified portfolio. The third thing is that diversified portfolio give you higher probability for a decent return. So here ends our presentation. If you have any questions, please feel free to contact us. The website is Sharpe Investor Group. Sharpe is SHARPE.com, or you can send us the email, or you can go to Calendly to schedule a 30 minutes call to discuss your own scenario. Our philosophy is that we want to invest with you to help you to invest with confidence and with the trust. So yeah, thank you very much.
Yep. Yeah, and great. Thank you for the presentation. We did have a couple of questions here first coming up as well. Mm-hmm. With some individuals, I guess the concern one individual had is kind of the changing demographics in the country with people, with the younger generations using cash less and less often. Mm-hmm. Is that something that maybe the ATMs in that type of an investment may still be viable for the next 10 or 15 years, but that you foresee in the future will mm-hmm. be less and less viable? I guess, and I know you went through some of that, but that was one of the questions that we have, and so just wanted to speak a moment on that, and I had a couple other questions as well.
That's a perfect question. I actually do have the data, but because of the time, I actually not showing the data. Hopefully you can see this. Can you see this page?
Yep. Mm-hmm.
Right. So we cover one type of demand for cash called cash by necessity, because the underbanked or unbankable population. Another type of demand is called cash by choice. So those are the fun facts about cash demand for cash by choice. So here, young people use cash more than any other payment instrument. So the data here, I can show you. The age group between 18 to 25 use cash with 34% chances. It's actually the highest probability within all the age group. The second group is actually age 65 plus. They use cash with 33% probability. So that actually answers your questions. Young people do use cash, although it's
Okay.
counterintuitive, but this is the fact.
Right, and actually, somebody's asking if you want to pull up your contact information up again, just to have it up there, so as we talk here, as people can reach out to you.
Absolutely.
Um, then, another person was asking, kind of, they were saying they can see a higher demand for ATMs, but how does that asset class, does it increase in value, or is it a matter of you're not really looking for the value increase, you're just looking for kind of a cash flow metric, I guess would be the question I have. But that was the question, is how does this asset class increase in value, or again, maybe it doesn't, that's not what you're looking for.
Right. So as I mentioned, that every asset, they have their own benefit to your portfolio. Let me start with an analogy, right? So as we all know that we need to stay healthy, we need different, like we need three things. One is protein. The other one is veggie, the fat, or the other one is the carb, right? So every nutrition, they have different benefits, right? So you can't say, hey, I like the taste of meat, so I only eat meat, right? So veggie has its own benefit and fat has its own benefit. Same thing here. You will say, okay, stock, we know that it provides upside potential to your portfolio, but it also suffer with the downside risk. So I would think that ATM investment as an asset class, it's more like a veggie, right? So it's good when you think there is a chance of recession because it provides predictable cash flow. And it will not, the return of that asset class will not change as different GDP growth. If it's good or bad, it behaves the same. If you remember, every month it basically repeat the pattern itself. So that's why I think adding ATM to my portfolio first increase the predictability of the outcome of the portfolio. Second, remember that I said I have more visibility in 2 years more than in 5 years. So I want my investment to return cash flow in the shorter period. So ATM actually can provide stable cash flow, which means I collect my money much quicker than if I invest in an asset class, which depends on how much it will sell in the next 5 to 7 years. Does it make sense?
Yeah, it does. It does. And a kind of another follow-up, I guess. One
Mhm.
person just said, "Hey, you're right about opening one's minds, because they before they started listening to some of our webinars and being exposed, they had only invested in stocks and maybe some real estate. So kudos there." One question somebody had about investing is whether or not, for, I guess, for some of those private funds, as opposed to investing with the mom and pop, do you have to be an accredited investor to participate? And then is there a minimum investment that's typically required? I know we didn't talk about a specific investment, but what's your experience with those private funds?
Right. So of course, this is for educational purpose. I want to open up your mind about realizing the potential of different asset class, not be like a block by your own like a personal view about certain asset class. You can contact us for individual deals. We do have a current ATM deal going on that we can talk about. Based on my experience, most of the private investment, I think, is for accredited investors. If you are non-accredited investors, I think you still have chance, but the pool is much smaller. So the question becomes, how can I be accredited investor? I think SEC actually opens more doors for non-accredited investors. Traditionally, you have to be qualified based on your annual income or your net worth. But now another one will be, okay, if you can pass certain exams, you can also be accredited. It's not the easy thing to pass the exam, but if you cannot be qualified using other criteria, this is one thing that you can do. Or you can connect to more sponsors to ask them whether they take non-accredited investors.
We have time for maybe one more question here, and we'll wrap it up. A question somebody's asked that if they were looking to invest in ATMs, which product would I Google search today? Is there a kind of a particular product or something they could, or maybe even place they could go to learn more about this type of an investing? Obviously, they could contact you, but is there anything, any other resources that they could look at?
So one thing about private investment is that compared to stocks you can find a tons of information out there, right? So for private investment, a lot of information are not public. So to do this research, I actually spend months doing all this research. Some of the research we have to pay for it, but I think we provide the if you just want to know this asset class in general, I think this is probably the best that you can find on the internet. But of course, in terms of specific investment opportunities, there's a lot that we don't cover today. Like from deal design perspective, how do we mitigate the risk? I actually have a lot of slides talk about that, but that's deal specific. That's why I leave that out. If you're interested, you can contact us. We can give you more details about that.
Okay, and I kind of had one other question just for a second. Was kind of are there other you know, I guess assets other than ATMs maybe that are also famously recession resistant? Or I'm just curious, other things, what other types of assets? Is it kind of rental real estate, or you know, what other kinds of things would be recession resistant assets?
Yeah, so I will mention some candidates for recession resistant asset class, and those are also on our radar. So this year or next year, we will increase the weights to those recession resistant asset class to include it in our portfolio. But as I mentioned, you have to be very cautious, because let's say everybody is talking about multifamily. It is recession resistant asset class, but in terms of specific investment deals, you have to pay attention. What is the cap rate that you pay for? If you pay too high for a recession resistant asset class, your room for error is very, very thin, right? So be cautious about the competition and the crowdedness in that space. So that's why I like the ATM, because a lot of people, they have a misconception about that. So that means that the competition is less. But other than ATM, what's on our mind? You can do your own research. So for example, the mobile home park is on our radar, and for example, mortgage notes, because who knows, when the Fed stop printing money, it's possible that you may observe some delinquency, right? If that happens, the mortgage note might be a good investment, but we don't know. So it starts with your research on how this asset class perform in historical terms, and then see, okay, whether this is a good investment to add to your portfolio. Right, so I mentioned mobile home park, self-storage, and then also ATM, and also mortgage notes. Those are just one of several. Of course, multifamily is always recession resistant. You just need to pick the right deal to invest it into.
Gotcha. All right. Well, Jan, thank you again. Thank you very much for your time today. Great presentation, very educational, and I'm sure everybody that was listening today live got a lot out of it. And again, if you're someone who's listening to the recorded version of this, my contact information is on the screen, and Jan shared hers earlier as well. So please don't hesitate to reach out to either one of us with any questions. But Jan, thank you again very much for your time today.
Before we end it, I want to show people how to find the free educational content on our webinar. Are we still showing my screen?
Oh no, I can give you the presentation right back. So yeah, you should be able to show right now where to find that information.
Perfect. So one last thing I want to share before we go is if you go to Sharpe Investor Group, again, it's SHARPE, sharpeinvestorgroup.com. There are several places that you can find free educational content. One is that you can scroll all the way to the bottom and then subscribe so that you can, so here, if you subscribe, then you will receive a free weekly newsletter every week. We will talk about the data, the trend, some interesting concept every week in the weekend. And if you go to these webinars, you will see all this like 1 hour long educational content here. So for example, last year I compare the historical performance of different asset class in real estate. How did they behave in the past 20 years? I also compare the single family versus multifamily, and then I also compare the investing in out of state versus home state. The most recent one I compare the what we call co-investing mode. So basically, it's a Groupon mode for real estate investing. As I mentioned, that if you invest as individual passive investor, you face a lot of challenges. But if we group together as a group of passive investor, we can actually get a better deal. So I think it's very similar to shopping in Trader Joe's. So just watch those videos, and then I believe that you will learn something. Yeah. So that's what I want to share.
All right, good. All right, good. Jan, thank you again very much for the presentation. Yeah, maybe we'll have you back on. Those other topics sound very interesting as well, and I'm sure our listeners
Mhm.
would get a lot out of it. So maybe we'll look to have you back again here later this year. But again, thank you again, everybody, for attending. This concludes the webinar today. Again, if you
Mhm.
have any questions for myself or for Jan, please reach out to us. Again, Jan, thank you very much.
Thank you so much for having us, and we will send out the PDF version after this call, and then together with the video, and then yeah. So I look forward to have another presentation. Thank you.
All right, thank you very much. If anyone wants a copy of the slides, you can just reach out to me, and we'll make sure that we get them to you as well. So thank you again very much.
Thank you. Bye.